Let me stop you right there, because what you're about to do, or what you have already done with your gold position, is going to cost you more money than you have made in the last 5 years combined. I don't care about your feelings. I don't care that CNBC has some talking head in a nice suit telling you the gold trade is over. I am Carl Icahn. I have fought, clawed, and won on Wall Street for over 50 years. And I am here to tell you one thing with absolute mathematical certainty. The unthinkable is about to happen to gold and silver. And the people who understand what I am about to explain to you are going to make generational wealth, while the people who do not are going to watch it happen from the sidelines, broke, bitter, and blaming everyone but themselves. Pay attention. This is not entertainment. This is survival. Now, before I give you the most valuable 30 minutes of financial education you will ever receive, and I mean that literally, because the pattern I'm about to walk you through has preceded every major gold rally in the last half century, you are going to hit that subscribe button. Not because I need your validation, because this information, if you paid a Wall Street analyst for it, would cost you thousands of dollars in consulting fees. And you are getting it for free. Subscribe, hit the notification bell, and stay in your seat, because what comes next will permanently change the way you think about money, crisis, and every hard asset you own for the rest of your investing life. Here's the first thing you need to understand, and I want you to tattoo this on your brain because most retail investors will never grasp it. Gold does not respond to fear. Let me repeat that, because I know it contradicts everything. The gold. The community has been telling you gold does not respond to fear. Gold responds to liquidity. There is a difference, and that difference is the entire reason your gold position is sitting in the red right now, while oil tankers are being attacked in the Persian Gulf and central banks are hoarding bullion like it's going out of fashion. So let me walk you through the mechanical sequence, because this is not an opinion. This is a repeating, documented 50-year chain reaction that happens every single time a major geopolitical event hits the oil markets. And if you understand the chain, you will never panic sell a hard asset again. Step one, a geopolitical event occurs. A war breaks out, an embargo is slapped on, a revolution topples a government. It does not matter what the trigger is. The moment that event creates uncertainty in energy markets, oil prices spike. That is step one, and everyone understands that part. Step two is where most people fall off the map. When oil spikes, inflation does not immediately go up. What goes up immediately and viciously are inflation expectations. Markets are forward-looking machines. Traders, bond desks, and Federal Reserve governors are not sitting around waiting to see what the consumer price index says next month. They are pricing in the pain right now. Step three, the Federal Reserve cannot cut interest rates. In fact, in several of these historical scenarios, they have had to raise them. Why? Because cutting rates into rising inflation expectations would be like pouring gasoline on a fire. And even the most politically compromised Fed chairman knows better than to do that publicly. Step four, bond yields go up. This is the critical domino. When the Fed cannot cut, yields on U.S. government debt rise, and the 10-year Treasury starts paying investors a real, guaranteed, government-backed return that suddenly looks a lot more attractive than a yellow metal that pays zero dividends and costs money to store. Step five, the U.S. dollar strengthens. Every frightened institution, every sovereign wealth fund, every foreign government with dollars to park moves that capital into U.S. treasuries during a geopolitical panic. Demand for dollars surges, the dollar index rises, and here's why that matters for gold. Gold is priced in dollars. When the dollar goes up, gold denominated in those same dollars becomes more expensive for every buyer on the planet is not America, which is most of the gold buying world. And step six, the step nobody talks about, is that all three of these headwinds, the rising yields, the strengthening dollar, and the frozen Fed, hit gold simultaneously. Not sequentially, simultaneously. That is why gold drops during a crisis, not because the trade is broken, not because gold is no longer a store of value, but because the mechanical plumbing of the global financial system creates three compounding reasons for capital to flow away from gold and into dollar-denominated debt in the first weeks of any major shock. Understanding this single sequence puts you ahead of the overwhelming majority of retail investors who see a red portfolio and assume they made a mistake. They did not make a mistake buying gold. Their only mistake is not understanding the sequence well enough to hold through it. Now let me show you the history, because I'm not asking you to take my word for anything. Numbers do not lie. And the historical record of gold's behavior around every major oil shock in the last 50 years is so consistent, so mechanical, and so repeatable that dismissing it requires a level of willful ignorance I find genuinely offensive. Let us start with October 1973. OPEC cuts oil production and imposes an embargo on the United States. Oil quadruples from $3 a barrel to $12 a barrel in a matter of months. Now, what does gold do? Gold initially drops, exactly as the mechanical sequence I just described would predict. It drops, and then, over the following 2 years, gold rallies 150%. And if you zoom out and look at the entire inflationary decade from 1971 to 1980, the full consequence of that oil shock and its successors, gold went up 2,300%. That is not a typo. 2,300%, from roughly $35 an ounce to over $850 an ounce. Now let us go to 1979, the Iranian Revolution. The Shah falls, oil production in one of the world's largest producing nations collapses almost overnight. Oil prices go vertical. And gold initially does very little. It absorbs the initial shock, the mechanical suppression kicks in exactly as described, and then over the following 12 months, gold rallies 89%, not in a decade, in 12 months. And then it continues higher. Then we get to 1991, the Gulf War. Iraq invades Kuwait. Oil spikes dramatically and quickly. In this case, gold actually moved more quickly than in prior cycles, up approximately 10% in just a couple of weeks, as the initial shock was priced in before pulling back and then resuming its structural uptrend as the recovery sequence began to 2001. September 11th, the markets crash, the world panics, and what happens to gold over the following decade? It begins a 10-year bull run from approximately $250 an ounce to $1,900 an ounce. Browns, do the math. That is a 760% move in 10 years, beginning from a point of maximum geopolitical fear and market dislocation. And then 2022, Russia invades Ukraine. Oil spikes, gold breaks through $2,000. The pattern, without exception, and without a single miss in 50 years of modern market history, has been this. Gold gets suppressed mechanically during the initial shock, and then it rallies powerfully, often to new all-time highs, as the structural and monetary consequences of the crisis play out over the following months and years. The data is unambiguous. Every single one of those crises eventually produced a significant gold rally. The only variable is timing. And timing, I will tell you right now, is exactly what separates the investors who compound wealth over time from the ones who thrash in and out of positions and wonder why their accounts never grow. Now here's the part where I need you to lean in, because this is where the current situation diverges from every prior cycle in a way that should make the hair stand up on the back of your neck, if you still have any. The structural conditions supporting a gold and silver rally today are not just comparable to what we saw in 1973 or 1979, they are more extreme. They are more extreme across every single measurable metric. And I want to go through them one by one with you so you understand exactly what kind of setup you are sitting in right now. First, the debt situation. In 1973, when gold began its historic run, the United States national debt was approximately $500 billion. Today, we are sitting at approximately $36 trillion, and roughly $9 trillion of that needs to be refinanced in the near term. Here's what that means in practical terms. The United States government currently pays more in annual interest on its debt than it spends on its entire military budget. Every aircraft carrier, every fighter jet, every soldier, every defense contract combined, the interest payment on U.S. debt exceeds all of it. That is an extraordinary structural vulnerability, and it means the Federal Reserve is not operating with a free hand. The Fed is trapped. They cannot keep rates high indefinitely because the cost of carrying the national debt at elevated rates is mathematically unsustainable. The bond market knows this. The smart institutional money knows this. And when they collectively internalize that rates must come down because the alternative is a sovereign debt crisis, that is the reversal trigger for everything I described in the mechanical sequence. The dollar weakens, yields drop, and gold's three headwinds disappear simultaneously. Second, central bank buying. In 1973, central banks were net sellers of gold. They were dumping reserves onto the market. Today, central banks purchased over 1,000 tons of gold last year alone, over 1,000 tons. These are not retail investors reacting to YouTube videos. These are sovereign institutions with decades-long mandates, making a deliberate, strategic decision to diversify away from U.S. dollar reserves. Why? Because they have watched the United States weaponize the dollar through sanctions, asset freezes, and the ability to simply turn off access to the global dollar clearing system for any country that crosses a political line. Central banks around the world, in China, in Russia, in the Middle East, across the emerging market world, have concluded that holding dollar-denominated assets is a geopolitical risk, not just a financial one. And their response is to buy gold. That is a structural demand tailwind that did not exist in any prior crisis cycle. Third, silver supply deficit. In 1973, there was no structural supply deficit in silver. The market was reasonably balanced. Today, we have been in a documented supply deficit for 3 consecutive years. The world is consuming more silver than it is producing. Industrial demand for silver, from solar panels, from electric vehicle components, from AI data center infrastructure, from defense electronics, is consuming supply at a brax rate that mining production simply cannot match. The largest silver refiner in the world has restricted exports. COMEX silver inventory, which was sitting at approximately 120 million ounces not long ago, has drawn down to around 76 million ounces and continues to fall. A silver stress index currently sits near extreme readings. This is not speculative. This is documented inventory data from the exchanges themselves. And fourth, de-dollarization. The gradual but accelerating global trend away from the US dollar as the world's singular reserve currency is a slow-moving but enormously powerful tailwind for hard assets. Every percentage point of global trade that shifts away from dollar settlement is a percentage point of structural demand destruction for the dollar and a corresponding increase in demand for alternative stores of value, of which gold is the most historically proven. The bottom line is this: you are not sitting in the same setup that existed in 1973. You are sitting in a setup that is structurally more extreme, with more debt, more central bank buying, more silver scarcity, more industrial demand, and more de-dollarization pressure than any prior cycle in modern history. The mechanical suppression you are experiencing right now is happening against an even more powerful structural backdrop than the one that produced those historic gains I just walked you through. So now you know why gold drops during a crisis. You know the history, you know the structural setup. The question every single person watching this video is asking is, when? When does this move? When do I get in? When do I get out? And the answer, whether you like it or not, requires you to understand the 4-phase recovery pattern, because the investors who have made the most money in every prior cycle have not been the ones who timed the exact bottom. They have been the ones who understood which phase they were in and positioned accordingly. Phase 1 runs from approximately week 1 through week 4 after the initial crisis event. This is the panic phase. Oil spikes, markets drop, financial media goes to 24-hour war coverage with dramatic music and red graphics specifically designed to trigger your most primitive fight or flight instincts. In this phase, most retail investors do one of two things, both of which are catastrophically wrong. Either they panic sell their gold and silver positions at exactly the moment the mechanical suppression is doing its worst, locking in losses based on fear rather than analysis, or they panic buy gold at the very top of the war spike, chasing price at the point of maximum media hysteria. Institutions in phase 1 are doing neither. They are watching, they are patient, they have seen the pattern before, they are reading the mechanical sequence, checking the models, and waiting. Phase 2 runs from approximately month 2 through month 3. This is the absorption and suppression phase. The VIX, the market's fear index, begins to pull back. The initial panic dissipates slightly, and what happens to gold? Gold drops further. Silver drops more, sometimes 15, sometimes 20% from its spike high. And this is the phase where the real damage is done to retail portfolios, not because the trade is wrong, but because the retail investor looks at their screen, sees continued red, reads a headline about gold being oversold, and sells. They take the loss. They declare the trade a failure. They move on. And this is, in my experience and in the documented history of every major crisis cycle, the single most destructive financial decision most individual investors ever make. Because phase 2 is not the end of the trade. Phase 2 is the setup. Phase 3 runs from approximately month 4 through month 18. This is where the money is made. The broad market begins to stabilize. Institutional rotation back into growth assets begins. Gold finds a bid again, not the emotional, panic-driven spike of phase one, but the deep structural bid backed by central bank purchasing, supply deficits, and the growing recognition by bond markets that the Fed must eventually pivot. Miners start to leverage up the gold price movement, typically moving 2 to 3 times the percentage gain of gold itself. Energy stocks continue their rally, and the retail investors who sold in phase two, they are sitting on the sidelines watching prices move higher, telling themselves they will wait for the pullback. The pullback does not come, or if it comes, it is shallow and fast, and they miss it waiting for a deeper entry that never materializes. Phase 4 begins around month 12 and can extend 2 to 3 years beyond the initial crisis event. This is the all-time high phase. This is where the pattern completes itself. New highs, higher than pre-crisis levels, higher than the initial spike, higher than anyone who sold in phase 2 thought was possible 6 months earlier. This has happened after every major oil shock in modern history. 1973, 1979, 1991, 2001, 2022. New all-time highs in the aftermath. The investors who understood the phases, who held or accumulated through phase 2, who did not get shaken out by the mechanical suppression, are the ones who captured those gains. The question you need to answer for yourself right now is which phase you believe we are currently in, and whether you are going to position yourself accordingly or watch from the sidelines. Let me now give you the specific, actionable framework, because I did not build a multi-billion-dollar portfolio by talking in generalities. There are 5 sectors that have outperformed in every major geopolitical crisis over the last 50 years. And you need to understand not just which ones they are, but why they work and how they work together as a portfolio that can protect and grow your capital, regardless of how the geopolitical situation ultimately resolves. Sector 1 is gold and gold miners. The simplest, most liquid entry point for gold exposure is GLD, the SPDR Gold Shares ETF, which tracks the spot price of gold directly. But if you want leverage to the gold price without the complexity and risk of margin trading, you look at GDX, the VanEck Gold Miners ETF, which gives you broad exposure to the companies that dig gold out of the ground. Here is the mathematics of why miners matter. When gold goes up 10%, miners typically go up 20 to 30%, because the mining companies' profit margins expand dramatically at higher gold prices while their cost structures remain relatively fixed. We are talking about operational leverage built directly into the business model. Physical gold ownership, buying coins or bars and storing them, has the advantage of eliminating counterparty risk entirely. You own the asset outright. No ETF structure, no custodian risk, no Wall Street intermediary standing between you and your gold. The trade-off is storage costs, insurance costs, and a premium over spot price. Both approaches have merit. The right allocation between physical and paper gold depends on your specific situation. But the core point is this: gold and gold miners belong in a crisis portfolio, and the miners give you amplified upside exposure to the gold price movement that is coming. Sector 2 is silver. You can access silver exposure through SLV, the iShares Silver Trust ETF. Now, I want to be clear that silver's investment thesis is significantly more complex and more powerful than just being a cheaper version of gold. Silver is simultaneously a monetary metal and an industrial metal. And that dual nature creates an extraordinary opportunity in the current environment. Silver goes into solar panels. Silver goes into electric vehicles. Silver goes into AI data center infrastructure. Silver goes into defense electronics. The world's transition to clean energy and advanced technology is not slowing down. It is accelerating. And all of it requires silver. Combined with the monetary safe haven demand that gold also captures, silver has a demand profile unlike any other commodity or precious metal in the world right now. And as I already described, supply is not keeping up. 3 consecutive years of supply deficit, COMEX inventory drawn down by roughly 40 million ounces from recent highs. The largest refiner restricting exports. Historically, in prior crisis cycles, silver has outperformed gold by a factor of 3 to 1 over the recovery period. If silver does even a fraction of what it did in the 1979 cycle, adjusted for the current structural deficit and the industrial demand tailwind that did not exist in 1979, the potential return is significant. Sector 3 is energy. The simplest way to get broad exposure to the energy sector is XLE, the Energy Select Sector SPDR Fund, which gives you diversified exposure across the major integrated oil companies, exploration and production companies, and energy services firms. The logic here is straightforward. Approximately 20% of the world's oil supply moves through the Strait of Hormuz. Any sustained disruption to that choke point, and we are already seeing attacks on shipping in the region, pushes oil prices higher and pushes energy company revenues and profits higher with them. Energy stocks are a direct, liquid way to participate in the oil price spike that accompanies geopolitical instability in the Middle East. And XLE gives you that exposure across the entire sector without the concentration risk of picking individual names. Sector 4 is defense. The aerospace and defense sector, accessible through ITA. The iShares U.S. Aerospace and Defense ETF is the most historically consistent performer in every major geopolitical crisis. After September 11, defense stocks outperformed the S&P 500 by 47%. The logic requires no great analytical insight. When nations go to war, governments spend money on weapons, intelligence systems, aircraft, vehicles, and all the military hardware required to prosecute a conflict. Defense contractors do not experience a recession during geopolitical instability. They experience a revenue boom. And defense budgets, once expanded in response to a crisis, rarely shrink quickly after the crisis ends. The political economy of defense spending ensures that elevated budgets persist for years after the initial trigger event. ITA gives you exposure to the entire basket of major defense and aerospace contractors, which is the appropriate way to position in a sector where the specific beneficiaries of any given conflict can be difficult to predict in advance. Sector 5 is utilities. And I will acknowledge that utilities are not a glamorous investment. They are boring. They pay dividends. They move slowly. And they have dramatically outperformed every other sector during major market sell-offs, driven by geopolitical shocks. In 2022, when Russia invaded Ukraine and the S&P 500 dropped 15% in the aftermath, utilities accessible through XLU, the Utilities Select Sector SPDR Fund, were essentially flat. When everything else is bleeding, the boring domestic dividend-paying utility sector holds value precisely because its revenue is not correlated with geopolitical risk. People pay their electricity bills whether there is a war in the middle. East or not, utilities are domestically regulated, domestically operated, and backed by the most predictable revenue streams in the economy. In a crisis portfolio, they are the stabilizer. They are the sector that keeps you from panicking when your other positions are down, because while gold and silver are working through their mechanical suppression, utilities are doing their boring, dependable job and protecting your capital. A properly constructed geopolitical crisis portfolio is not 100% gold. It is diversified across all 5 of these sectors, weighted according to your risk tolerance, your time horizon, and your conviction in the specific catalysts I've described. It is a portfolio built to both protect capital during the suppression phase and aggressively capture the upside during the recovery phase. That history tells us follows every major oil shock without exception. I am going to leave you with the most important thing I have said in this entire video, and I want you to sit with it, because it is a question about character as much as it is a question about investing. There are 2 types of investors watching this right now. The first type sees gold pulling back from its highs and concludes the trade is over. They tell themselves they should have sold at the top. They switch off, scroll to the next guru, get pitched on cryptocurrency or AI penny stocks, and 6 months from now, when gold is printing new all-time highs and silver has already made its historic move, they will say they knew, they should have held. They will have been right about the direction and still lost money, which is the most expensive and most common form of financial incompetence there is. The second type sees the same pullback and recognizes it. They see phase 2. They see mechanical suppression. They see the structural setup, the debt trap, the central bank buying, the supply deficit, the de-dollarization becoming more extreme, not less extreme. And they accumulate quietly, exactly the way the institutions accumulate, exactly the way the central banks accumulate, without fanfare, without emotion, without needing the validation of a rising price to confirm their conviction. That type of investor does not need to be smarter, wealthier, or better connected than anyone else. They simply need to understand the mechanics. Now you do. The question is, what you are going to do about it. Because the unthinkable that is about to happen to gold and silver is not a mystery. It is a pattern. It is documented. It is repeating right now in real time. And the only real question is whether you are going to be on the right side of it or not.